Okie dokie. Okie dokie, everyone. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And welcome and thank you for joining me tonight on the latest episode of the Discover Trading series for Wise Bank. Now, tonight's episode is called Discover the RSI and an Introduction to Other Oscillators, Part 1, written by myself, which is, of course, James Alexander, and I'm the Chief Market Analyst here at Wise Bank. Now, let's give you a brief introduction on myself. Like I say, I'm the Chief Market Analyst here at Wise Bank, and I've actually been in the financial service industry for over 20 years. I actually started out as a mortgage broker in the UK. As you can tell from my accent, I am indeed a Brit, but don't hold that against me, obviously. After doing mortgages, I actually went into pensions and alternative investments before getting involved in online trading and trading in general. I've actually traded, I do trade myself, and I have traded for several prop companies, and I've ran several trading floors around the world, including the likes of the Philippine Stock Exchange, etc. I'm indeed a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times, Advisor, Market Watch, of the Street, and several leading well-known industry magazines and newspapers. I'm an avid market commentator. I'm extremely passionate about the markets. I put that down to the fact that I was allowed, maybe against my parents' best overall supervision at the time. I was allowed to watch Wall Street at a very young age, and I started getting very passionate about the stock market and things like that back then. So I'm very passionate about the markets. And I'm a well-known public speaker, and I've spoken at several events around the world, including like Singapore, Dubai, Kuwait, Qatar, London, obviously, and Berlin. Now, like I say, tonight's episode of the Discover Trading series is all about basically an introduction to oscillators and the RSI. This is, like I say, this is part one. I will be doing part two later down the line. I don't like trying to put too much in one episode because otherwise it gets a little bit overwhelming, and plus at the same time you'll probably get bored and sick of my voice. So anyway, tonight's agenda, we'll talk about what are oscillators, the theory behind oscillators, examples of oscillators. Then we'll do a few market examples of two oscillators, which I'll talk about, with charts, which are obviously recent chart movements today. And we'll then discuss the rest of December's educational schedule. And of course, I'll have my usual question and answer session at the end. So if you do have any questions related to this presentation or related to anything in relation to the market or whatever, please feel free to ask me at the end. No problem. So, what are oscillators? An oscillator is a type of technical analysis indicator which can potentially be used by a trader to identify if a trend might change, and is really used to find overbought and oversold areas. This potentially works when an asset is at an extreme value and either the overbought or oversold zones. That sounds really good, James, but it's, what's about the theory? Well, the theory behind oscillators, or stochastic oscillators, it was really developed by a man by the name of George Lane back in the 1950s. And actually, hats off to George Lane, actually, because most people who develop or design technical indicators usually name it after themselves, but he didn't. So hats off to him. He developed it back in the 1950s, and his theory was oscillators basically calculate the closing price of an asset in conjunction with the high and low of the range that asset is trading in over a period of time. Now, his theory is that the oscillator follows the momentum of the price of an asset before the actual price actually changes, which many people believe can then predict a sudden change in direction. In other words, it calculates, this is not a calculation you have to do. The indicators does it itself. But basically, what they're trying to say is that they calculate the closing price of an asset with the range of the high and lows in that range. And instead of focusing so much on the actual price, it actually tries to calculate where, or gives us a hint of when something might change. Okay? Where we might see a sudden change in direction, i.e. an end of an uptrend or an end of a downtrend. And traders really look for these because the idea is that if they can identify these, then they can jump into the market to capture that change in direction. Now, George Lane, like I say, he really believed, or he really believed, he's obviously passed away now, it's 1950s. He really believed that oscillators can really identify when an asset is overbought or oversold. And why is this important, James? Well, the theory is that if an asset reaches overbought levels, there is no sellers left in the market. And if an asset reaches an overbought level, then there are no buyers in the market, which suddenly means that if it's overbought, the buyers will start to sell off. And if it's oversold, the sellers will start to buy again. And by doing this, it will change the direction of the asset. Now, there is quite a good number of oscillators. And like I say, in part 2, and probably I might do part 3, we'll discuss a lot more on these oscillators. But for tonight's episode, we're only going to focus on 2. But there is a good number of oscillators, and these include the likes of the following. The relative strength index, which is very popular, and tonight we will talk about. And parabolic SAR is another oscillator. Moving average convergence divergence, or simply known as MACD, that we'll also talk about tonight. Commodity channel index, the CMI. The average directional index, ADX. And the detrended price oscillator, or DPO. But for tonight's episode, like I said, we're only going to talk about the RSI and the MACD. Now, the relative strength index, or simply known as the RSI, is infamous, incredibly famous. And a lot of traders swear by them, though, again, like everything, though it does have its merits and it does show its worth, and it doesn't work all the time. But we'll go through some examples anyway. But this is the idea, or the theory. The RSI, again, follows the momentum of an asset. And the theory is that it can show us potentially when an asset is overbought or oversold. Remember, if it's overbought, the market might start selling off again. Oversold, the market might start buying in again. So this is what we're looking for. Now, the RSI has a value range between 0 to 100. And the theory is that if the value is above 70, the asset is potentially overbought, and that could cause a sell-off. And if the value drops below 30, the asset is potentially oversold, which could encourage the market to start to buy in again, pushing the asset higher. So that's the theory. 70 and above, overbought. 30 or below, oversold. Direction of the asset may change. So let's have a look at some examples. Now, this is a euro sterling on a 30 minutes. And I trade this pair a lot myself. Why? Is because I just like it, and it's a very good, I hedge it with another currency pair, which tends to work a lot for me. But anyway, I like this pair. It doesn't get it's only a minor. It's not a major. It doesn't get a lot of attention. But anyway, this is euro sterling on a 30-minute chart. Okay, so each candle remembers 30 minutes. So here's our candlestick chart. And here, let me get my little pen. Laser pointer. There we go. Got my pen. And this is our RSI. Remember, this is the 70. This is the 30 level. So anything above the 70, potentially overbought. Anything under the 30 level, potentially oversold. And it could then predict a future movement of that asset. So let's have a look. Market is moving higher. So the euro is moving higher against the sterling on a 30-minute. And what's the RSI telling us? RSI is above 70, actually at quite extreme level of 80 at this point. And what does the market do? It sells off. So the euro started to collapse against the dollar. Against the sterling. We then have a directionally low sell-off here. RSI approaching around the 30 levels. Starts to move and starts to buy in again, as we can see then. And indeed, the market changed direction and starts to buy in. Remember, the RSI is what's known as an early warning indicator. So it's not as soon as it hits the level that it changes. It comes close to the level and it gives us a hint that something is about to change. Let's do another example. This is the British pound US dollar, and this time it's on a daily. So each candle represents a day. So we have our daily candlestick chart and we have our RSI. Remember, the 70, 30. Okay, so let's have a look. Comes above the 70 level. The sterling is rising against the dollar, hits the 70 level, hints that it's overbought, and guess what happens? The market does a massive sell-off. However, again, this is why I will always indicate, and I'll tell you the open, the reality of everything. Here we go. Here, obviously the RSI here is now at 30 or below 30. So technically the market should start to buy in, right? This time it didn't work. The market continued to sell off, and it didn't really kick in to a lot later, around this point where it was really, really getting close to even 20, way below the 30. That's when the market started to jump in and buy in again. So again, like I say, like every indicator, like every theory, it works, but it does not work every time. Comes again close to the 70 level, overbought, and what happens? The market indeed sells off again. Comes close to the 30 level. This time it does work. The market jumps in, and indeed the pound goes up against the dollar. Now this is euro dollar on 1 hour. There's another example. Again, like I said, the RSI. Personally, there's a personal opinion. I like the RSI on a longer time frame, but you can use the RSI on shorter time frames. I like it on longer time frames because, like with most indicators, on a longer time frame, it tends to give you more of a better image and picture of what is really occurring. So this is the euro dollar on 1 hour. That's a nice little jump up there. A nice little bit of a bull run for the euro. What happens? Gets above the 70. And guess what? The market Not so dramatically, but does indeed over time starts to sell off again. Remember, early warning indicator. Okay. Then it falls under 30, oversold. What happens? The market starts to buy in again, gets to overbought. The market starts to sell off again. This time it's sort of ranging a little bit. It does come close to the 70. And yes, in some ways you could say the market, well, in many ways, the market does indeed start to sell off, but it's not dramatic till later down the line, gets under 30. And guess what? The market starts to buy in again. Moving average, convergence, divergence. Let's just try and say that again because that sounds easy, James, doesn't it? Moving average, convergence, and divergence, or simply known as MACD. Now, this is another indicator which is very popular. And really, again, this is using moving averages. I don't know if any of you people have ever attended my moving average episode, but I'll do more of those in the future. Now, the difference between the moving average and the MACD is that the MA with a MACD is not really calculated on price, but it's calculated on the difference between two MAs. Now, those of you who maybe use moving averages crossover, okay, as you might know the theory is that if you're using not the MACD, this is the moving average crossover, that if you say you use like a 24 moving average and maybe a smaller moving average of 12, the theory is that when the 12 crosses over the moving average of 24, then it indicates a change in direction of an asset. Okay, because don't forget the moving average is calculated on the closing price of an asset over a period of time. But MACD is different. MACD, again, like the RSI, uses moving averages, but in a different calculation, again, to try and give us an indication of when something is overbought and oversold. But the difference is it really gives us a stronger signal when the two MAs are wider apart. And this is what gives us what's known as a histogram of bars. Now, the bigger the bars, the faster that the two MAs are moving apart, and the bigger difference or the bigger potential the market has to move in that certain direction. Now, obviously, the histogram gets bigger as the faster MA moves away from the slower, and that's called the divergence. And the histogram gets smaller as the two MAs get closer together, and that's called convergence. So, okay, that sounds really interesting, James, but how does it actually work? Well, let me sort of illustrate it to you. Sorry, I just having a sip of my coffee. Right, so this is the euro dollar on 1 hour, and this is our MACD at the bottom. Now, the blue one, or the blue line, okay, is the smaller, more moving average, or the smaller MA, or the faster MA. And the yellow one, or you could actually say it's mustard, is the slower one, or the larger one. Now, like the moving average crossover, it's really about when the smaller one, as in the blue line in this case, crosses above the larger one or the slower one, means the direction is possibly changing. Okay, either if it crosses above it, the idea that it's going to move up higher. If it crosses below it, indicates to us that again it's about to move lower because it's overbought. But it's not just that. You see these here, these are called the histograms. And the more histograms we have, the slightly stronger the move may be. The lesser of the bars we see means that things are quite close and means it's not, or the asset's not, in either an overbought or oversold levels. So let's have a look. Here we go. The faster is crossing above the slower. Got some nice bars here, so means the difference is really widening, and let's see what happens. The market starts to move higher. Around this point, very close together, okay, there is very little bars, and what happens, the market tends to really stay in a range. Again, the faster crosses above the slower, big bars for big volatility, big difference between the two, and guess what happens? The market indeed moves higher. Crosses below, the bars, again, the histogram gets wider, and what happens to the asset? The asset starts to fall, and so on. Crosses below, bars widen, and the asset starts to fall. Let's look at another example. Cold today, so I'm thirsty. This is the dollar Japanese yen, again on a daily. So we have our MACD and we have our dollar Japanese yen. Obviously, it's about a nice steady upward momentum, crosses below it, histogram widens, and what happens to the asset? The asset, or in this case the dollar, falls against the Japanese yen. Again, passes below it, the faster passes the slower one, bars widen on the histogram, and indeed the asset starts to collapse. Faster moves above the slower. We can then see some steady bars here on the histogram, and what happens to the asset? The asset indeed moves higher. Falls below it again, bars start to widen, showing the difference between the two MAs. And what happens to the asset? The asset starts to fall. Again, we can see it clearly here. Now, look, if you look at here, this is before I point to this one. Look, the bars, and it's very, very close together, no big gaps, and the bars are very, very narrow, so very small bars, meaning that the movement is not there, means the market is ranging. We only really look for it when there's a big dramatic move and the bars actually are quite wide, like we do on this, and the market does indeed starts to sell off. And there's another prime example of it crossing below, bars widening on the downside, and indeed the dollar falls against the yen. One more. This is gold on 1 hour. Okay, so we have our MACD, we have our gold. I love gold, by the way. That was the very first asset I ever traded, was gold. So let's have a look again. The faster crosses above the slower, few bars there, widen, and what happens to gold? Gold prices moves up higher, crosses below, or the faster crosses below the slower, and indeed we get the bars then widen, and what happens to gold? Gold starts to sell off. Again, very, very, very close together. The bars are very, very thin, which really is saying that, apart from that little movement there, is pretty much ranging. But at this point, this is what we're looking for. The faster crosses below the slower, the bars widen, and what happens to gold? Gold starts to sell off again. Right. Up and coming educational events the rest of December. The next one I'm doing is on the 20th of December, and that is Discover WTI, crude oil, and Brent. It actually was a request by somebody, or one of my people who do attend a lot. They actually want me to do a case study on these two commodities, these two energies. Both very exciting. So on the 20th, I'm going to do a case study on these two. We're going to discuss fundamentals, technicals, and really get to grips with what WTI, oil, and Brent and CFDs actually are. So it's on the 20th, and I look forward to seeing you all there, I hope. If you wish to contact me, or you have any questions or anything like that, please feel free to email me. What's wrong with me? I've got marbles in my mouth. Email me at james.t@wisebank.com, or alternatively, you can follow me on my Twitter account, which is at JamesAlexanderT, where you can actually direct message me or just sort of follow me. Because on my Twitter, it's a brand new Twitter account. I've just recently set it up. As you can see, I have so many followers. But anyway, On my my Twitter account, what I do with this is I do share market updates, charts, patterns, things I potentially am seeing or looking out for. And but like I say, it's a good way of keeping in contact with me as well. If you wish, wish to talk to me. So, on that note, is there any questions in relation to tonight's episode or anything in general? Anybody like to ask me anything? Any questions at all? Hi, by the way, is it Fami? Hi there, my friend. Hope you're well. Any questions whatsoever? Don't be shy. Feel free to ask me. Whatever anybody like to ask. Just type it to me. Any questions at all? Okay. Did you at least enjoy it and found it useful? That's a nice question, Farin. I hope I'm saying correctly. Is the RSI enough for trading? My answer to that is no. No. And I'll tell you why. Because trading is not just about indicators. Okay? Trading is about having actually a trading plan and risk management. Okay? And you need to have that. That is more important than technicals. Is having a trading plan and being in control of your risk is far, far more important. RSI is useful and can be useful, as I show in my examples, to give you a hint of where something may be heading soon, but you don't do all your trading just based on that. You can use it, but as long as you have risk management as well in place, that's what you need as well, along with the RSI. And here's the other thing as well, okay? Because some technical indicators, some people love certain different type of technical indicators. Like some love the moving average crossover. Some love Bollinger Bands again. And again, it depends, does really depend on your style of trading. But the RSI you can use if you're looking for overbought, oversold levels. And it does become useful if you have your risk management in play. Because like I showed you on one of my other examples, it doesn't always work. But good question. Very good question. Any other questions at all? Or here's another thing. Let me ask you a question then. Is there any subjects or topics you might like me to do in the future? How many indicators do we need for trading? Again, a very good question. A very good question. Now, this is my opinion. Okay, this is not the answer. This is my opinion. But in my opinion, you should only really ever use maybe 2 or 3 indicators at the most. Even then, with 3 indicators, it's a little bit overwhelming. There's too much noise and too much visual stuff on your chart, which, okay, in that case, can I just say a big thank you to everybody who attended tonight. Massive thank you to everybody. Big shout out to, I hope I'm saying your name correctly. Is it Farmin or Farmin? Big shout out to that individual there. Fantastic questions. Thank you very much for asking questions. I do love it when you're interactive because otherwise it gets quite lonely at my side. But some very good questions about the indicators and about the RSI. So a big thank you, and a big shout out to you, sir or madam. Thank you so much for asking those questions. On that note, till next time, can I wish everybody either a good morning or good afternoon or even a good evening, depending on where you are around the world. Till next time, every single one of you, trade safe.